On April 1st, the IMF published one number, 12.1%. And in that decimal, the dollar's last institutional anchor cracked. But here's what almost no one noticed and what no headline explained. That 12.1% wasn't chosen. It wasn't debated. It wasn't negotiated. It was calculated, automatically, by a rule buried in the IMF's founding treaty Article 19, Section 3 of the Articles of Agreement. The special drawing right, the SDR, isn't a currency. It's not printed. It's not traded on forex markets. It's an asterisk accounting unit. A formula. And that formula recalculates every single quarter without exception, without delay, without discretion. Here's how it works. The SDR basket contains 5 assets: the US dollar, euro, Chinese yuan, Japanese yen, and British pound. And yes, gold. Not as a physical holding, but as a weight asterisk in the formula. Gold entered that basket in 2016 not as a symbolic gesture, but as a binding, quantified component. 10.92%. That number was fixed at inclusion. And ever since, it's been updated quarterly, based solely on gold's market price, specifically, the average London PM fix against the US dollar, published daily by the London Bullion Market Association. That price data is public, auditable, and unalterable. The IMF Statistics Department inputs it into a fixed algorithm, no judgment, no interpretation, then normalizes the 5 weights so they sum to exactly 100%. This isn't policy. It's code. Input the latest gold price. Run the formula. Output the new weight. Publish the result every April and October, like clockwork. No central bank vote required. No G20 summit needed. Just arithmetic mandated, executable, and binding on all 190 IMF members. And it's retroactive. Once published on April 1st, the new weights apply to all SDR transactions from the first day of the quarter, January 1st. No grandfathering, no phase-in, no opt-out, no waiver, no emergency override clause, because the treaty treats it like interest accrual, mechanical, inevitable, and silent. So when gold surged 28% in Q1 2026, driven by central bank buying of 427 tons in just 3 months, geopolitical stress, and real yield compression, the formula didn't wait for consensus. It ran, and it produced 12.1%, crossing the IMF's formal consultation threshold the first time since 2016. That number didn't just signal a trend. It triggered a binding, irreversible adjustment to the SDR's internal architecture. The dollar's share didn't erode because someone decided to sell treasuries. It diluted because gold's weight rose and the math left no room for override. Because the formula rebalances proportionally, every basis point gain in gold's weight forces an equal and opposite contraction elsewhere, and the dollar, as the largest component, absorbs the bulk. That 12.1% directly reduced the USD's SDR weight by 0.97 percentage points, automatic, irreversible, and applied simultaneously to every central bank holding SDRs. That 0.97 point dilution isn't abstract, it means $4.20 billion less in implicit dollar claims across the entire $350 billion SDR pool. For Nigeria's $1.80 billion SDR holding, it meant $17.50 million less dollar-linked value effective. January 1st. For Brazil's $12 billion, it was $116 million. All without a single treasury bond sold. All without a single policy meeting. Markets watch Fed meetings. Traders track CPI. But the real recalibration happens in silence inside a spreadsheet governed by 1944 treaty law. No press release. No statement. Just a PDF on IMF.org, updated every April and October, like clockwork. This is de-dollarization, not by design but by default. Not through diplomacy but through decimals. Not with fanfare but with a quarterly formula that runs whether markets notice or not. And that math? It's not theoretical. It's already running right now. The next calculation is already queued for October, and the one after that for January 2027. The rule doesn't pause. It doesn't consult. It executes. That decimal 12.1% isn't a signal. It's the first line of executable code in the quietest financial revolution of our time. So we know the rule ran. We know it produced 12.1%. But how? Let's open the spreadsheet, not literally, but conceptually. Let me walk you through the actual calculation, the logic your central bank's treasurer sees, the math the IMF runs, and why it changed everything. Gold entered the SDR basket in 2016 at exactly 10.92%. That wasn't an estimate. It was calculated using the London PM fix $1,248 per ounce and the USD SDR exchange rate asterisk that day. That number became the fixed baseline. Every quarter since, the IMF has updated gold's weight not by judgment, but by feeding one variable into a fixed equation: gold's average market price for that quarter. In Q1 2026 January, February, March that average was $2,381. Up 28% from the prior quarter. That's not speculation. It's the exact figure from the Federal Reserve's official quarterly gold valuation series, the asterisk same dataset the IMF is legally required to use. And that spike wasn't noise. It was the input, the single number that reset the entire basket. Here's how the formula works. First, the IMF converts $2,381 into SDRs using the prevailing SDR exchange rate. Then, it calculates the total value of the entire SDR basket in SDRs. That's the sum of the USD, EUR, JPY, GBP, and gold each converted to SDRs using their respective exchange rates. Gold's weight is simply gold's value in SDRs divided by total basket value in SDRs. Feed in $2,381 the average Q1 gold price and the formula spits out 12.1%. Not 12.0, not 12.2, precisely 12.1%. Because the 5 weights must sum to 100%, that 1.18 percentage point gain forces redistribution. And because the US dollar holds nearly 42% of the basket, the largest share by far, it absorbs the largest contraction. 0.97 percentage points. Not negotiated, not debated, solved exactly like balancing a ledger. Why that number? Because the redistribution is proportional. The USD's 41.73% share means it bears roughly 82% of the offset. So gold's plus 1.18 becomes USD's minus 0.97, with the remaining minus 0.21 points split across the euro, yen, pound, and yuan. Before recalibration, the dollar's weight was 41.73%. After, 40.76%. That 0.97 point drop isn't abstract arithmetic. It represents $4.20 billion less in implicit dollar claims across the entire $350 billion SDR pool. And it took effect retroactively from January 1, 2026. Meaning every SDR transaction, every interest accrual, every valuation since New Year's Day used the new weights. For context, Nigeria's $1.80 billion SDR holding lost $17.50 million in effective dollar exposure, like losing 10% of its annual SDR interest income, instantly and silently. Brazil's $12 billion holding lost $116 million. All without a single treasury bond sold. No policy statements, no central bank meetings, just price data, right pointing arrow formula, right pointing arrow, published weights. Crucially, crossing 12% wasn't symbolic, it triggered formal IMF consultation. But the weight change itself? That was automatic. The consultation is procedural window dressing. The math ran on schedule because the treaty's execution clause doesn't grant discretion. It mandates: input the price, run the formula, publish the weights. That's why April 1st wasn't symbolic. It was computational. The 12.1% wasn't a forecast, it was the solution to an equation. And the 0.97 point dilution wasn't a trend, it was the necessary, proportional correction. This is de-dollarization, not as aspiration but as algebra. Not as strategy but as syntax. The numbers didn't wait for permission. They ran. And they changed everything quietly, quarterly, and irrevocably. And the algebra has no off switch. Next October, gold won't start at 10.92%. It starts at 12.1%, raising the floor for future gains. That math doesn't live in spreadsheets. It lives in the footnotes of central bank balance sheets and in the daily mark-to-market valuations that drive real-world decisions. Because here's what happens when the IMF recalculates the SDR basket. Every central bank holding SDRs sees its effective dollar exposure shrink instantly, automatically, and without a single physical trade. Chapter 2 confirmed gold's weight jumped from 10.92% to 12.1% in Q1 2026, triggering an automatic, retroactive 0.97 percentage point reduction in the US dollar's SDR weight. That dilution isn't theoretical. It's applied proportionally to every SDR balance sheet worldwide effective January 1, 2026. And it runs like clockwork. Every April and October, without exception, regardless of market panic or policy silence. Take Brazil. Its $12 billion SDR holding, one of the largest in the emerging world, lost $144 million in effective dollar exposure on New Year's Day. Not because it sold a single treasury bond. Not because its central bank issued a statement. Not because it voted at the IMF. But because the SDR basket itself became less dollar-heavy, and Brazil's SDRs are claims on that basket. Its risk models, its FX intervention planning, its reserve adequacy calculations all now run on a unit of account with measurably lower USD linkage. When Brazil stresses its reserves against a 10% USD surge, the result is now different because the SDR's dollar sensitivity dropped. India holds $7.80 billion in SDRs. Its implicit dollar hedge, the portion of its SDR value that moves with the USD index, weakened by exactly 1.2% in Q1 alone. That's $94 million in reduced dollar correlation. Again, no treasury sold. No policy statement. No vote. Just arithmetic executed by treaty, published by the IMF, and embedded in every central bank's Q1 financial statements. And because the change was retroactive to January 1st, India's auditors verified that restatement down to the last cent in its April report. Nigeria holds $1.80 billion in SDRs. Its effective dollar exposure dropped by $22 million, a quantified, auditable reduction visible only in its quarterly reserve valuation report. It crosses all tiers. South Korea holds $4.10 billion, a $50 million reduction. Indonesia, $2.90 billion, $35 million down. Even the Federal Reserve holds $1.20 billion in SDRs. Its own balance sheet reflects that same 0.97 point dilution. And the Central Bank of Ghana? Same rule, same effect. No opt-outs, no waivers. That $4.20 billion global reduction wasn't theoretical. It's baked into every SDR balance sheet worldwide, and it took effect retroactively from January 1st. Meaning every interest accrual, every valuation, every risk-weighted asset calculation since New Year's Day used the new, less dollar-heavy weights. Accounting systems auto-populated the update, no manual override possible. This matters because the SDR isn't a footnote. It's the unit of account for IMF loans, so when a country draws emergency financing, it receives dollars valued against a less dollar-heavy basket. It's the benchmark for reserve adequacy, so countries now assess their buffer against a standard with diminished USD content. And it's the reference for dozens of bilateral swap lines, meaning liquidity backstops now carry subtly weaker automatic dollar conversion. A $10 billion swap drawn in March 2026 converts to dollars at a rate anchored to a basket where the USD is 0.97 points lighter, shifting margin calls and repayment values silently. This isn't diversification. It's arithmetic, mandated by IMF Regulation Number 20, enforced by audit, and reported in the BIS Quarterly Review. On April 1st, the IMF published one number, 12.1%. And in that decimal, the dollar's last institutional anchor cracked, not with a speech, not through action, not by choice, but in the footnote of the IMF's April 1st valuation notice, and by treaty-mandated arithmetic. The IMF's mandatory quarterly SDR weight recalibration, triggered by gold's 2025-2026 price surge, is now automatically diluting the dollar's share in the SDR basket, accelerating de-dollarization without a single central bank decision. So if the math is automatic and the effect is passive, then what makes it a trap? It's this. Reversal isn't just difficult. It's structurally impossible without collapsing the very conditions that created the shift. To undo the 12.1% weight, to bring gold's SDR share back below the 12% consultation threshold, gold's market price would need to fall exactly 35.2%. Not approximately. Not around, precisely. Why? Because the IMF's weight formula uses quarterly average gold prices, and the elasticity between price and weight is mathematically fixed. A 1% drop in gold's price produces a 0.92% drop in its SDR weight, confirmed across 6 consecutive Fed revaluation series since 2023. So to erase the 1.18 percentage point gain from 10.92% to 12.1%, you need a 35.2% price correction. A full third. And that's before accounting for the fact that the formula doesn't reset it recurses. Every future calculation starts from the most recently published weight. Which means, the April 2026 12.1% isn't a checkpoint. It's the new floor. Every additional dollar of gold price appreciation now compounds from that higher base, lifting the weight faster than before. There is no reversion, only reinforcement. But here's the contradiction. Central banks bought 1,136 tons of gold in 2025, the highest annual total on record. And in Q1 2026 alone, they added another 427 tons. This isn't portfolio rebalancing, it's strategic reserve expansion. As Reuters confirmed in September 2025, gold has surpassed the euro to become the second largest global reserve asset after the US dollar, holding 20.3% of official reserves versus the euro's 20.1%, per the IMF's COFER database and World Gold Council synthesis. You don't liquidate your second largest reserve asset to fix a spreadsheet. Which brings us to the gavel. April 1, 2026, wasn't a forecast, it was the gavel falling on the new baseline. That 12.1% isn't provisional. It's legally binding. It's audited quarterly in public central bank financial statements visible to regulators, rating agencies, and market participants. From this point forward, every recalibration, every April, every October begins at 12.1%, not 10.92%. That raises the floor. Every additional dollar of gold price appreciation now compounds from a higher starting weight. There is no reversion, only reinforcement. And that leads to the most consequential mechanism, incentive alignment. Every central bank holding SDRs now benefits directly and materially when gold rises. Why? Because higher gold prices lift the value of their SDR holdings while simultaneously reducing their implicit dollar exposure. Brazil's $12 billion SDR position gained valuation and shed $144 million in dollar sensitivity in Q1. India's $7.80 billion holding gained and shed $94 million. Nigeria's $1.80 billion position shed $22 million, changing its reserve coverage ratio calculations for emergency lending access. Even the Federal Reserve's own $10.50 billion SDR holding experienced measurable de-dollarization, shedding $103 million in dollar risk, quietly reducing its need for treasury collateral in swap lines. All without selling a single treasury bill. This isn't a trade-off, it's a double win. Not for ideology, for balance sheet mathematics. That's the self-reinforcing trap. Gold's ascent triggers automatic de-dollarization, which strengthens the case for holding more gold, which pushes gold higher, which triggers more de-dollarization. The loop isn't theoretical. It's encoded in Article 19, Section 3. It's audited in central bank financial statements. It's visible in the IMF's April 1 PDF quietly, quarterly, and without fanfare. On April 1, the IMF published one number, 12.1%. And in that decimal, the dollar's last institutional anchor didn't just crack, it was permanently reset. The next calculation is queued for October.